One. Hey everyone, Logan Hertz here with Hazeltine LLC. We are back for more on the First Lien HELOC velocity banking strategy. We've been getting a lot of comments and we thought we'd address some of them. And so to do that, I brought in the expert on velocity banking, which is not me, D'Andre Clayton. How you doing, my friend?
I'm swell, man. I'm swell. Such a pleasure, man, to be here as usual. We always have a good time together.
Yeah, excellent, excellent. So you notice how I'm not pretending to be an expert on everything. I love velocity banking. I love the First Lien HELOC. I think it's a great strategy. But I'm not the world's foremost expert on it. I'm kind of like Denzel Rodriguez would say he's an expert on velocity banking. He's a practitioner of infinite banking and he knows enough, but he's not necessarily an expert. I'm
Yeah.
kind of the inverse of that. I consider myself an expert on infinite banking. That's really my forte. And then velocity banking is a great complement to that. I know a lot about it, much more than the average person, but I don't pretend to be an expert on everything, right?
Yeah.
I find it very suspicious when people try to be an expert on everything. Oh yeah, I can. Yeah, I call them Me Too iguanas, right? A lot of financial professionals are like that. Oh yeah, I can do that. Yeah, I can do that too. Yeah, I can do that. I can do that too. Yeah,
Yep.
yeah.
Yep. It's impossible, man. It is impossible. I think anybody who positions themselves that way, it is just a measure of hubris that is outstanding.
Well, and I
Um,
think they're afraid they don't want to turn down business, right? They think it's going to result in less money for them, which it doesn't. What you find is like me, the more I stay focused on infinite banking, the more I can be all things to my clients by using partners,
mm,
right? So
mhm.
I don't have to be, I know enough to do the overall planning, take the big picture, walk them through everything. But when it comes to like the details, the execution,
Yeah.
I'm only going to do the infinite banking piece,
Yeah.
right?
Because I'm not getting a mortgage license.
Right. Right. So with that said, we're continuing to respond to some comments. At this point, we've gotten so much, we're not going to be able to respond to all of them. But we'll respond to a few. So this is continuing with our friend Thomas, and we're going to respond to just one of his comments today. So I'm going to go ahead and bring that up, and I will let DeAndre do most of the talking. Um,
Right.
DeAndre, he says this is a total non-starter.
Okay. For who, Thomas? I mean, I don't really have to do much explanation. I think we just got to be careful with blanket statements. Thomas, I mean, is it a total non-starter for a person who, only has 1,000 of disposable cash? Is it a total non-starter for a person who has 20,000 of disposable cash, 10,000 of disposable cash? Because there's so many different people out here in the world. So I would first start with that. But let's go on. Replacing low interest mortgage by a higher interest debt that is not even fixed rate. So first and foremost, and this was posted 2 weeks ago, the current mortgage rates are not low. So once again, are we just only talking about clients that are, have had their house for 8 years or have had their house for 6 years? Sometimes there are some of my clients who are refinancing into a first lien HELOC and actually getting a better rate on their first lien HELOC than their mortgage today. That has happened. It's unusual, but it has happened. Uh, Also, if I am getting a house right now, I don't know why I would want a fixed amortized loan right now in a high interest environment. So I would definitely prefer if I had the money to enter a first lien HELOC, I would prefer it to not be fixed right now at this particular moment because interest rates do drop as well. Oh,
Right. And that gets to what he said next, because this is a non sequitur. He says the HELOC is not even fixed rate. And then he says, this is the non sequitur, meaning the interest is likely to climb. Well, how do you know where interest rates are going? Right. I mean,
yeah.
for the past few, if you rewind a few years, interest rates have been going down for multiple years. So if you got a variable rate HELOC, your interest rate was going down for many years. It's only recently that interest rates have gone up. So
Hmm.
yeah, interest rates might go up or they might go
Yeah.
down. So just because it's a variable rate doesn't mean the interest will go up. It could
Yeah.
go down.
12%, 12 years ago, the interest rates were horrendous. So, interest rates are not just always in a spiral of going up, and they're not always in a spiral of going down either. But I would also state when he says that is not even fixed rate, you can fix the interest on a HELOC for a period of time. So there are some clients who
Right.
choose to lock in their interest for 5 years. That
Right.
is not my advice to do so in a high interest rate environment. I would rather be variable in a high interest rate environment. So that's also not necessarily true as far as that is not even fixed rate. Now, claiming that you will pay your debt back in 7 years instead of 30 by using the HELOC is at best disingenuous.
Misspelled. He
Oh,
misspelled
okay. All
disingenuous.
right.
And also, I just want to point out, he says this is a terrible idea. Again, for who?
Yeah,
For who? You can't make blanket statements like that. If you don't have financial discipline, it is a terrible idea.
yeah,
It is a terrible idea, right?
yeah.
Um, if you don't have positive cash flow, it is a terrible idea.
Yeah,
Okay.
absolutely. Absolutely. I
So
would
again, you
agree.
can't for who, right? I mean, in what situation, right? So
Yeah.
so yeah, claiming that you will pay your debt back in 7 years instead of 30 using a HELOC is at best disingenuous, at worst a terrible lie. Well, I know someone who, the person who introduced me to the first lien HELOC, I had already known about velocity banking, but I
Yeah.
didn't know about the first lien HELOC. She paid off her house in less than 3 years, and she still talks about how easy it was.
Yeah.
So I don't know who you're working with, but I've seen it happen.
Yeah. Yeah. Same here. The person who introduced me, he paid off two homes in 3 years. So he had, a balance left on a home that he had basically rented out, and he still had some money left over on it, and he still had some money left over on the home he was living in. He combined it both and went ahead and wiped it all out in 2 years. So uh, I don't know how he's coming up with this as it's being impossible, because if he's saying it's impossible, we would have to define what is the income of the person, what is the expenses of the person, where do they live, what's the type of taxes in the area that they live in. All of those are different variables that would be
Oh, come on, D'Andre. It's better if we just make blanket
Yeah,
statements with
I know.
incendiary
I,
terms, like telling you you're a liar. Come
I
on,
know,
we
I
can't
know,
have nuance. We
I
can't have
know, I
nuance.
know, I know, I know. I know everybody's mortgage is
Let's just
exactly
call
the
each other
same.
names and
Their
use.
homeowners insurance costs the same. The taxes cost the same. Everybody makes exactly the same thing. The principal makes the same thing as teachers. All that kind of stuff. Yeah, I'm aware. Everybody is exactly the same. I don't know what
Right.
society that's in,
And
but
we can reduce it all to the fact that, the mortgage has a lower interest rate and the HELOC has a higher interest rate. Therefore, the mortgage is better, right?
I guess so. I guess so.
Okay. What
All right.
accelerates debt payment is making extra payments above the regular monthly payments. Okay, I'm not necessarily going to disagree with that.
Okay.
That is what is being done with that HELOC. Okay. The
Okay.
same can be done more cheaply and with less risk with the mortgage. Now
So
for a second, let me back up. What accelerates debt payment? Well, who said we're trying to accelerate debt paydown? We might be. This is velocity banking, and it can be used in a lot of different ways. So maybe we're trying to pay off debt, but maybe we're not. Maybe we are real estate investors and we're going to increase our debt strategically. So we're going to pull from that HELOC and use it to make a down payment on a rental property. Unless some deal came up and now we got cash, we can pounce on it. Maybe we're going to draw from our HELOC and purchase a whole life policy, right? I mean, there's so many things that you could do. So velocity banking is not about debt pay down necessarily. That's
yeah.
a particular use case for velocity banking. It's not velocity banking, right?
And to your point, I actually had a client who was looking for a used tractor trailer truck. He wanted to become an owner operator, right? So he went to school. He had been doing jobs previously, that were in the trucking business, but he didn't have his own, right? And that's what he wanted to do. He makes far more money per month than he did when he did not have the tractor trailer truck that he owns now. So he took out the debt from the HELOC, he purchased it, and went ahead and started driving. And the routes that he is driving is paying him significantly more than what his salary was paying during the time that he was driving for the company he was driving for. I, I hope people understand that this is, once again, this is not about just paying a house off, right? This is about you finding ways to use capital to increase your value, increase your income, do whatever you can do. I mean, on a regular basis, I have clients that are paying off homes with the HELOC, right? They're paying off their rental properties, and then now that rental property has, the debt has moved over, but now they're getting the full income, right? So it's important for people to get that more than anything, because I'm really tired of the argument of home mortgage versus HELOC.
Right, right. It misses the bigger picture.
It misses the
It's kind
bigger
of like
picture.
with infinite banking, where people get lost in whole life insurance
Right.
mechanics, missing the bigger picture of I'm
Absolutely.
becoming my own banker. Right.
Absolutely.
So
I-
same thing here. It's not just about mortgage versus
yeah,
HELOC. That's not
absolutely.
just what it's about. Okay. So the same can be done more cheaply and with less risk with the mortgage, D'Andre.
Okay, more cheaply. Well, one, that's bad verbiage. Cheaper is what you're saying. But when you're talking about less risk than the mortgage, how do you define that?
Mm-hmm.
Why do you say it's done with less risk than the mortgage? If
Mm-hmm.
a person put all of the remaining discretionary income into a mortgage payment, I do not know how you would say that is less risk
Mm-hmm.
than doing it in a HELOC. I just don't
Mm-hmm.
grasp that. Because I mean, all right, their car crashes and they have a total car, but they maybe didn't have the right amount of insurance to get full value on it to go and purchase another car. And we know how much the values of cars have inflated. Um, but they've been putting all this money in their mortgage.
Mm-hmm. Mm-hmm.
They don't have access to that. Are they at risk?
Right. Right.
Yeah. If they lost their job and they have the mortgage, obviously that is a huge risk according to stats. As I mentioned on the last video, there was 100,000 foreclosures just in the first 3 months of last year. All right, so that's risky. A mortgage is not a non-risk product. I don't know why people present it that way. Surely it is not that. But yeah, I
Yeah,
don't
and
think.
also he says less, he says more cheaply, right? Well, first of all, again, you're focused on one thing in isolation. I disagree. I mean, I think if you have the right cash flow, HELOC will be, you will pay less in interest. But again, as compared to what? So if I pull money from my HELOC to go purchase a rental property, I increased my cost inside the
Mhm.
HELOC. That's true. I'm now going to pay more in interest. Does that mean it's dumb? I mean, if you take this argument to its logical conclusion, you should never spend money on anything
You should
because you're
never.
raising your
Yeah.
costs,
Yeah.
right? So
It's
yeah, I'm going to pay more in interest, but now I purchase a cash flowing asset that I could not have purchased otherwise because I wouldn't have had access to capital on
Mhm.
such favorable terms. And if I'm practicing velocity banking and running my cash flow through that HELOC, the interest costs are gonna be lower because the principal is going to get paid down so quickly.
Mhm.
So it's not just to your point about, well, it's not just about paying off the mortgage faster, right? It's also not just about reducing my interest costs,
Mhm.
right? Every time, if I'm a real estate investor, every time I go to purchase a property and I'm financing it, I'm increasing my interest costs, right? But that makes sense because I'm purchasing a cash flowing asset by so doing, right?
Absolutely.
So the
Absolutely.
question is, what am I getting for that extra expense? That's the question. What is the value that's providing me,
Yeah,
right?
That's a good point because I think the other part about more cheaply, and I always love what you say, compared to what, right? Because all right, so he has a mortgage, he does exactly what you're saying, but what if he has $20,000 in credit card debt?
Hmm.
Was
Hmm.
it smarter to do extra payments on the mortgage, or would it be smarter to pay off the credit card debt with the HELOC?
Hmm. Hmm.
Which one would cost less in interest?
Hmm.
If you leave that 20,000 out there and you continue trying to make your own monthly payments, creating your own monthly schedule, it is going to destroy you in comparison to the difference between whatever saved interest you think would be on the mortgage
Hmm.
and the HELOC, because the difference on the mortgage and the HELOC's interest rate is not the difference of a HELOC's interest rate and a credit card.
Right. Right.
So
Right.
think macro. Stop with the micro. Think macro.
Yep. Well said. Well said. Okay. Re-interest. That 3% mortgage is going, so now he's going to some specifics. We didn't, yeah, I think specific to that presentation. Um, that 3% mortgage is going to cost about 9,000 the first year if making no extra payments, was the 4.75 HELOC. So these numbers are referring to the presentation I was going through. So
Presentation.
obviously these numbers are out of date, but again, the conceptually works the same way. So a 3% mortgage and a 4.75% interest HELOC. Taking into account the monthly deposit of $10,000 is going to cost over $13,500. So I think D'Andre, what he's pointing out, which we wouldn't deny, is that in year one, the HELOC would cost more in interest than the mortgage. Right?
Duh. Duh.
So we're not denying that, right? We're not
Duh.
denying.
Okay.
Yeah.
No problem.
Again, if making, well, he says again, if making no extra payments. Um, okay. A
No
net
problem.
loss of about $4,500 that year alone. A net loss. Okay. Well, first of all, as compared to what?
Lost. Yeah.
But yeah, I don't see that there's been a loss, but okay. You have a lot more. What about all the equity gain you've gotten in the HELOC
Yeah.
that you didn't get in the mortgage?
It seems like he doesn't care about the equity growing.
Yeah,
Maybe it's a detached thing because it seems like he doesn't recognize that, oh, there's an availability of capital that's opening up with each payment. So
right.
he can very well, he can very well, speak and try to, I guess, be eloquent in his approach with how much money you're going to be saving and all that kind of stuff outside of the home, but he can't, actually represent what has happened inside of the home, which is kind of interesting to me. um you know
Yeah, yeah. And then he says that loss is going to slowly go down each year. So when he says loss,
slowly.
that's not correct. What he
Yeah.
means is you'll be paying more in interest on the HELOC than on the mortgage. So he's saying the difference between how much interest you'd pay in the HELOC per month versus how much you'd pay on the mortgage per month is going to go down. But then he says, as principal is reduced, but the HELOC will cost more in interest right up to the last year of debt.
Is Okay, maybe I'm just lost because sometimes I'm lost on this. Is he not thinking that there's principal actually being paid on a HELOC? And because it's an interest only loan, that it's just that people are just paying the interest only? Because,
No, he's not saying that because he's saying as principal is reduced. So he's recognizing that principal is going to be reduced. So this can't be
okay,
correct because the HELOC will not, we've shown before, we've gone through the schedule
right.
where we've
That's what,
shown the monthly, and you can pull it up if you want,
yeah.
D'Andre. We can show you that the interest costs on the HELOC will be higher in year one, but very quickly it goes down to the point that you're paying a lot less in interest on the HELOC on a monthly basis than you would have on the mortgage because the principal is reduced a lot faster and your equity gain as well.
Well,
Right.
and I guess that's the reason why I asked that question, because while I hear what he's saying, the principal also is significantly reduced in year one on the HELOC.
Right.
not
right?
just so you could say, hey, you paid way more on interest. You also have to couple that with you paid way more on principal,
Mm-hmm. Mm-hmm.
not just that you paid way more on interest. So when
Mm-hmm.
you're talking about it going down slowly each year, how is it going down slowly if you're putting way more towards the principal each year?
It's going down exponentially.
It's going down exponentially, which drops the interest payment exponentially each year. So
Right.
I'm lost on that because I'm like, it seems like he gets one part, but he doesn't get the other part. He gets one part, he
Right.
doesn't get the other part.
Right.
So
Yeah. And we can even go through some numbers if we want to. But if you do make extra payments, the mortgage will still cost less in interest in the HELOC. No, it's not true. If you're making it apples to apples, it wouldn't. I mean, and of course, it's never a perfect apples to apples comparison. We
perfect.
understand that. But what does the HELOC provide? The only thing it does provide is saving of interest on part of the $10,000 deposited each month, depending on when the bills are paid.
What
So I
does
think what he's referring to here is the fact that if you put your money into the HELOC at the beginning of the month,
huh?
and then you pay your bills at the end of the month, there's a savings there because while your $10,000 was sitting in the HELOC, it
Hmm.
reduced your average daily principal
Hmm.
balance. And that's something that we don't talk about enough, I don't think, because it's something that we don't take account in our calculators, right?
Right.
Because we're just looking at your net monthly income that's going to be applied to the HELOC. But the fact of the matter is you're going to get more benefit
Yeah.
because your gross income is getting applied to the HELOC. And even if you pull it back out at the end of the month, it still reduces your interest costs, right? Because
Yeah.
for 29 out of 30 days, $10,000 was sitting in your HELOC, which means for 29 out of 30 days, your principal balance was reduced by $10,000, which means your interest payment, which is calculated on the average daily principal balance, is reduced quite significantly. So I'm glad he pointed that out because we agree on that, obviously. In the very best case scenario, that is still less than $500 per year. Well, he's assuming this is the only benefit, which it's not, right?
Right.
That would be the only benefit if you pulled all of your money back out every month, right? If you put in your gross annual income and then pulled all of it out every month, then yeah, that would be the only benefit. But we're not because you need to be cash flow positive for this to make sense.
Absolutely.
Okay, but the 1.75% difference in interest rates between mortgage and HELOC generates a cost of over $5,000 for the first year. So over 10 times more. I don't know about that. It makes no financial sense to pay $5,000 to save less than $500. Would you exchange a $10 bill for a $1 bill? So I think the only way what he's saying here would make sense is if you're never paying down the principal at all, which obviously
That's
that's not
that's why I
that's not
said
what
I
we're
don't understand it.
not
I'm
that's
like,
not what we're suggesting you do, right? Obviously. So I don't know what he's saying here. I guess yeah, to your point, it's kind of garbled. It's not coming across very well. But I guess, yeah, that objection would be fair if we were telling people don't ever pay down the principal,
yeah,
which
like
obviously is not what we're telling people to do.
I mean, it's literally the last sentence. I'm just like, I don't understand how you actually watch an entire video and come up with the last sentence.
Yeah, well, he probably didn't watch the video.
It makes no sense to pay $5,000 to then save less than $500. Would you exchange a $10 bill for a $1 bill? Have you watched the content? Like, have you actually
Apparently
genuinely
not.
watched it completely? Or are you just kind of responding based on, your own kind of biases about it? Because that is definitely not what's going on here. Would you exchange $10? And then what's funny enough to say, would you exchange $10 for $1 bill? That's fractional banking. That's exactly what you're already doing.
And then he says, and somehow
You're
the
actually
over
doing it.
$1,000 monthly interest to be paid for the HELOC seemed to have been forgotten in his videos. We were told that expenses are $7,000 before the HELOC, and those $1,000 plus are never added in. Actually, that's not true at all. As
That's
I
not true
addressed in
at
one of the
all.
comments later, your $7,000 of monthly expenses in this video includes the interest expenses on the HELOC. It's all inclusive, because someone else brought up that comment and I addressed that. So no, what he's missing there is the $7,000 includes all of your expenses, which would include the interest expenses on the HELOC.
And once again, this paints to the picture of him thinking that you are only doing an interest payment only and not a principal payment, because why would the monthly interest stay $1,000 the whole time?
Right, exactly.
Why would it stay $1,000 if you're paying down the principal? So I shouldn't be able to linearly see $1,000 across the board at all. Rather it be in a mortgage or a HELOC as the interest payment, if you understand how to calculate either one of them. That should never happen. The interest payment should never stay the same throughout the entire tenure. So
yeah, because your principal balance is going down. And now I'll tell you what I'm gonna do here. I'm gonna bring up the actual Excel sheet. So this again, this is a scenario where the difference in interest is actually more significant. So we have a $305,000 mortgage, 2.625% rate. And I think this was an actual case that I had. So this is someone who got the best rate during COVID, right?
Nice rate, yeah.
Versus 7 3/4, so much higher interest rate on the HELOC, right?
Yeah.
$12,000 a monthly net income,
Oh,
$5,000.
No, nobody makes $12,000 a month, man. Come on, man. No, you need to bring a real number up. There's nobody walking around saving $7,000, bro. Like they don't even make $7,000. What are you talking about? It's not 12 grand.
How about that? Negative 50,000.
Yeah. There you go.
So $12,000 a month and $5,000 in monthly expenses, not including their housing expense, right?
Gotcha. Okay.
Because their housing expense is now in the HELOC.
Because it's in the HELOC. Gotcha. Okay.
So let's look at this. So I'm going to skip over that for now because, okay, in month one, your interest payment on the mortgage is $667, right?
Yep.
Your interest payment on the mortgage on the HELOC is significantly higher.
Yep.
He's correct.
He's correct.
In year one, he's correct.
Mm-hmm.
It's much higher because the interest rate is higher. Okay. And you gain $557 of equity on the mortgage.
Mm-hmm.
We gained $5,000 in equity on the HELOC, right?
Mm-hmm.
We paid $5,000 towards the principal. Whereas here we only paid $500. That's because we're running our income through the HELOC. We're doing velocity banking. If you're not doing velocity banking, this doesn't make sense.
So
and again, conceptually, what's going on is not, oh, I made an extra $5,000 payment to my HELOC. No.
Right.
I'm running my cash flow through the HELOC, and that's automated. I'm not having to change anything I'm doing. All I'm doing is I'm switching my checking account that I'm using today with my checking account that I'll use tomorrow. That's automatically linked to my HELOC. So when my paycheck comes in, gets deposited in my checking account, it automatically goes to pay down the principal. I don't have to change anything I'm doing, right? So to say I'm making an extra payment, well, that's not exactly true. That's what's going on behind the scenes. But all I'm doing is switching to a new checking account and paying my bills from there. That's all, right?
Yep.
So let's fast forward a few years. Okay, well, let's look at, again, okay. So let's look at, okay, at the end of 3 years, so month 36, okay? Here we go. Our interest payment is $622 on the mortgage, okay? And $874 on the HELOC. Oh no, we're still paying more interest on the HELOC, D'Andre. This is terrible, terrible. Okay. How much equity have we gained? $175,000 on the HELOC.
What?
Versus on the mortgage, we've gained $20,000, $21,000 call it.
But the interest is supposed to stay the same.
Yeah.
It's
Look
supposed to
how
stay the
the
same.
interest came down from almost $2,000. What was it in month
No,
one?
no, no. It's
1969 down to
1969 the whole
$874.
time. It's 1969 the whole time. The whole time.
And obviously, the reason why the interest payment is coming down so dramatically is because our principal is getting paid off, right?
Right.
Okay, and then let's look at 48, 4 years in. Now our interest payment is less on the HELOC than on the mortgage. He said it would be more on the HELOC
Oh,
all the way to
and
the end. So
and he said down till the end.
yeah, so
Down
so
to the
in
end.
in month 48, and keep in mind the HELOC interest rate is significantly higher than the mortgage interest rate. The
Mhm.
mortgage interest rate is 2.6%. The HELOC interest rate is 7.75%,
Yep.
right? You're talking about 3 times as much. And here we go, month 48, your interest payment on the mortgage is $600. On the HELOC, it's $467. It's less.
Right.
It's coming down dramatically. Okay. We've gained $239,000 of equity versus only $28,000 of equity on the mortgage. And this interest payment, it actually goes up a little bit because we paid some expenses
Yeah, we paid the
out of
taxes.
HELOC at the end of the month. We pay, yeah, some taxes and things like that. And then it comes down, right? Notice that, again, the monthly interest payment is coming down, right? To only $73 in month 59, whereas over on the mortgage, it's still just under $600. And that didn't really come down that much, right?
Mm-hmm.
And then by month 61, we're about to pay off the house, right?
Yep.
So there you go. And again, this was with a mortgage interest rate that was about 1/3
Yeah.
of the HELOC rate. So to go back up, right, we're talking about a much more dramatic difference. It wasn't 3% versus 4.75%. It's 2.6% versus 7.75%.
But it's not a fair comparison because you're not adding all that extra money and the extra payment. They always want it to be, on the side of the mortgage. So you got to add the extra payments, even though there's a 5% difference on the interest rate. they,
Mhm.
they don't care about the 5% interest rate difference as being unfair for the HELOC, right? But
Right,
they want those extra payments to go towards the mortgage to make it feel more even.
right, right. And of course, again, the whole reason this works is because a HELOC is a two-way street. I would not recommend dumping your entire monthly net income into a
Never,
mortgage. That would not be a good idea
never.
because you can't pull it back out.
Yeah.
Right. So anyway, I thought, man, we might as well go through some numbers. Hopefully, it didn't confuse people
No
too
problem.
much. But yeah, just to show that, yeah, to your point, I'm not even sure what he's saying. The only way what he's saying would make sense is if he's assuming we never pay down any principal on the HELOC and
Yeah,
we're
we
just
don't.
making interest only payments,
But
right?
even then, he would be wrong because he is still painting the picture that eventually we would pay the house off in an interest only.
Mhm.
So he's confused all over the place because
Yeah.
I mean, if you're only paying the interest, there's no way to pay. I mean, it's
Right. Then you couldn't pay
you
principal down at all.
can't
Yeah.
pay the principal down at all. So, what very end would there be? You're comparing a very end of the mortgage and a very end of the HELOC, but if I'm making interest only payments, there is no very end of the HELOC in that
Right.
scenario. So, I mean, it's just just sit and think for a while before you make a comment. It's it's not meant to be mean, but there's so many different scenarios, and it's important for you to chew on the information before jumping to respond to something. It's okay not to be the first person to respond. Study what you're talking about first.
Yeah. And I think also there's a temptation to jump straight into the numbers without first backing up and understanding what we're looking at.
Absolutely.
I was, saw a video from Ryan Griggs and James Nethery recently. They were talking about someone who, bought a product that turned out very poorly for them because they were looking at numbers on a spreadsheet and the numbers looked amazing. What wasn't so clear was all the assumptions behind those numbers, right? And when those assumptions didn't exactly pan out, it blew up and caused them a huge amount of stress, right? So we first have to understand what we're doing conceptually so we know what those numbers mean. Because when we're trying to predict the future, we're always having to make assumptions.
Yep.
And that's the whole art, right? I did a lot of modeling when I was doing strategy consulting. I built operational models, I built financial models, I built revenue models
Oh, I
for
thought you were talking about
large
Lamborn.
Fortune 500 companies, okay? And the discussion was never about the numbers,
Yeah.
right? It's all about the structure of the model, which means the art of making good assumptions and
Mhm.
building a good model that's predictive, okay? And so a good model will spit out good numbers only if the assumptions going into that model are correct. And if
Mhm.
or at least reasonable, right? They can never be 100% correct because they are
Right.
assumptions. They're reasonable, right? And the structure of the model is sound. That's what it's all about. Once you have the assumptions right and the structure correct, then the numbers just a monkey could spit them out, right?
Right. Right.
So that's what it's all about, right? So, in our spreadsheet that I just showed you, we're making some assumptions, right? We're making some assumptions. There are assumptions that go into that. It's not going to work out exactly the way I showed, obviously. It's so that you understand the concept better and you see how you have a more efficient pay down schedule. But there are assumptions that go into it, right?
Funny enough, he even created a scenario where it would work out better when he said something about making the expense payment at the end of the month or something. Like he alluded
Right,
to that.
right.
It's like, well, do you understand it or not? Because that's actually very good advice. Because I
Yeah.
mean, if a person were to use it, it would actually perform significantly better than what the calculations are. Because the calculations are acting as though you got 12,000 coming in, 5,000 going out, all on the same day. That's
Mhm.
how the
Mhm.
calculations are, and
So
um,
we're handicapping the HELOC. It will look
absolutely,
better
you're
because
handicapped.
you're always going to have some amount of float where the money that you got comes in is going to sit
Yep,
there for some amount of time before you pull it out. So
absolutely.
yeah, in an ideal scenario, if you have the ability to do this, you should have all of your automatic bills paid at the end of the month. And usually you can do that at least as far back in the month as
Yes.
possible. So your income comes in at the beginning of the month, maybe it comes in biweekly, but either way, it will be sitting in your HELOC for 2 weeks, 4 weeks
Hmm.
before it comes out, and therefore it reduces your interest costs, right?
Absolutely. Absolutely. Yeah. So.
So that's why we call it velocity banking, right? It's not necessarily about paying off debt. That can be a way of using it. It's about putting all your money in motion. It gives your money velocity because now it's all working for you. None of your money is sitting idle in a checking account ever again. It's
Mhm.
all working for you by building equity in your house and by reducing your interest payment by participating more in the growth of the value of your house, etc. And then you can use that velocity however you want. You could use it to pay off higher interest debts. You could use it to pay off your house faster. You could use it to buy a whole life policy. You could use it to buy a rental property, right?
Yeah.
It's really up to you. And there's so many intangible benefits that we've talked about. Now you have access to liquidity, right? I mean, and there's nothing, you're not having to do anything. It's all automated. I mean, there's so
Mhm.
many benefits.
Yeah. A more peaceful life is a benefit. So
Absolutely.
absolutely.
All right. Well, that's the end for this session. We'll have more to come. But D'Andre, once again, thanks for your time. We greatly appreciate it. Look forward to the next one.
As always, my friend.